You're welcome back. It's still Nigeria's Economy Today from Super Screen Television. Last week, we started a discussion on pension fund administration in Nigeria. And the feedback we got from our viewers indicate that we need to continue with that topic. So today, we are bringing in a pension fund analyst will be joining us via telephone call. Comrade Ivor Takor is a pension fund analyst who will be joining us via telephone call to discuss Nigerian pension fund administration. Comrade Ivor Takor, are you on the line?
I'm on the line.
Hello, Comrade Takor.
Hello.
Hello. Thank you for joining us on Nigeria's Economy Today.
Thank you for having me.
Okay, I would like to start by asking, what's the difference between contributory pension scheme and the defined benefit scheme?
Yeah. The contributory pension scheme is a pension scheme where it is funded in advance.
Okay.
There are contributions are made by both, and then those contributions are invested. In our own case, in Nigeria, the employee opens a retirement savings account with the pension fund administrator, where these contributions are deducted monthly and paid into. And the law gives the PFA the right to invest the fund.
Okay.
So this is a pool of funds. While the defined benefit scheme, there is no ready pool of funds. What happens, especially in the public sector, when a person retires, money is made budgetary from the annual budget, and then fund is paid. There is no pool of funds. Moreover, in the contributory pension scheme, the rate of contributions are known. But what the income earned after retirement is not known. What the law provides is that on retirement, a pensioner or a retiree will first collect a lump sum, provided what remains is sufficient for the employee or retiree to buy an annuity with a life insurance provider or a program withdrawal, which is managed by the pension fund administrator.
Okay.
Okay,
thank you, Comrade Takor. Now, what are the economic benefits of this contributory pension scheme now?
Well, there are two. Let's look at for the employee. For the employee, the economic benefit is that
Okay, thank you very much. You mentioned earlier that the contributory pension, when a worker retires, he will get a lump sum,
yes,
and the remaining balance will either be used for annuity or we have a program withdrawal. Now, why is it that the worker cannot get the 100%, all his contribution at once? For instance, somebody that retires and wants to go into another business, why is it that cannot get 100% and go into his business peacefully and safely?
The contributory pension scheme is a retirement scheme. It is not a savings scheme. In a saving scheme, when somebody saves money and it is the time you need the money, you are giving the whole money, you take it. But it's a pension scheme. And
Pension scheme, we know it's very much on in the formal sector. How can the informal sector also benefit from the contributory pension scheme?
yeah, the law stated the number of persons an organization must have to get into the scheme. So that is mandatory. But because there was a need to have a full coverage of Nigerians, the National Pensions Commission, which is the regulatory body of the pension administration in Nigeria, took a proactive step in order to expand the coverage so that they can cover people in the informal sector of the economy by coming out with what is called micro pension scheme. Micro pension scheme is a scheme that has been fashioned out to take on board into the contributory pension scheme workers in the informal sector and also self-employed professionals. There are lawyers who are self-employed, engineers, and all manner of self-employed professionals. They can now key into the contributory pension scheme through the micro pension. And the micro pension is tailored in such a way that it takes into consideration their own peculiar situation in terms of how they can contribute, how they can remit contribution, and how they can then access the fund.
Okay.
So it's done to take in.
Okay, you've talked about the micro pension scheme. An artisan is doing his business alone. How can an artisan also tag along with this micro pension scheme? How can he be part of it?
That's why I talked about professional self-employed.
Coming back to the formal sector, we know at the end of every month, some workers' money used to be deducted for pension contribution. And some organizations don't remit this money that is being deducted to the pension fund administrators. What can be done, or what should be done to the organizations that will collect money from the workers and they will fail to remit this money to the fund administrators?
Yeah. What happened is that you are totally right. There are employers, majority of them in the private sector. They deduct the contribution. The law says that the employer is supposed they are forced to pay, and they pay penalty compliance with this provision of the Act. These agents are already at work.
Okay. You said when they don't remit, there is a penalty. And
Yes.
that penalty, will it go to the employees that his money was not remitted?
The penalty, when the money is not deducted, the penalty goes to the employee, RSA, because you know that the whole pension is the contributions are supposed to be invested. And when they invest, the return on investment and the contributions are what made the pocket for benefit payments. So when they default, these penalties, some also go into the employee, because if that money was there, it would have been invested and it would have brought in some return on investment.
Oh, that's clear. That's fantastic. Now, still talking about the employees. If an employee is working with an organization and decides to quit that organization to another organization, what is going to happen to its pension fund? Is it going to be transferred to another pension fund administrator, or it will continue with the one he's doing it with ab initio?
In the lifetime of an employee, yes, that employee opens a retirement service account with a PSA.
Okay.
That and gets a PIN number. That PIN number is personal to the employee. His RSA account is portable from one employer to the another. So when the retiree, or rather when the employee moves from one job to the other, he carries his RSA account with him. What he does is only, if he gets to employer B, he will only give his PIN number and the PFA. So the new employer will continue to deduct and pay in that separate account. So the RSA account is portable.
Okay.
He doesn't need to open a new account.
So the employee's money continues to grow. Now, Comrade Takor, I want to talk about the government employees now. Government workers.
Yes.
At different tiers of government, federal, state, or local government. We know that some of these government workers, their money is being deducted and is not being remitted. Because they are government, can anything be done to government that does not even remit the pension of the civil servants?
Yeah, you see, in the public service, like you rightly said, we have the federal public service, we have the state public service, and then the local government public service. The federal public service has fully keyed in.
Oh, we lost Comrade Takor there. Comrade Takor, can you hear me? That's too bad. We lost Comrade Takor there. We will go for a short break to reconnect with Comrade Takor and continue with the discussion on pension fund administration. Please don't go away.